Welcome to CJE Tutorial. In today's session, we will be exploring the latest developments shaping the world of global finance. For over half a century, the United States dollar has been more than just America's currency. It's the lifeblood of global commerce. It's the language of international trade. It's the bedrock of central bank reserves. It's the ultimate safe haven in times of crisis. After the devastation of World War II, the world needed a stable anchor. This was the Bretton Woods system. The dollar was pegged to gold. Other currencies were pegged to the dollar. It promised stability and predictability in a world desperate for both. The decision cemented the dollar's role as the world's undisputed reserve currency. The world's insatiable demand for dollars meant that the United States had to supply them. So how does a country supply its currency to the rest of the planet? The primary mechanism is by running a trade deficit. It must buy more goods, buy services, buy assets from the world than it sells, used to price oil, used to finance trade, used as the reserve asset for nearly every nation. For decades, this arrangement worked, fueling global growth and really cementing American leadership. It allowed the United States to finance its deficits cheaply, as the world eagerly bought its debt. But this privilege came with a hidden cost, a structural flaw that was identified decades ago. The inherent contradiction at the heart of the dollar's dominance has a name: the Triffin paradox. It was first articulated by Robert Triffin in the 1960s. The world needed dollars for liquidity. That required the United States to run deficits, but those deficits, if endless, would undermine faith in the dollar. Triffin saw the issuer faced an impossible choice: satisfy global demand and weaken its finances, or prioritize domestic health and starve the world of liquidity. For a long time, the world accepted the paradox. The benefits of a dollar-centric system seemed to outweigh the risks. There was simply no viable alternative. The United States economy was the largest and most dynamic. Nations from Europe to Asia accumulated U.S. Treasury bonds, effectively lending America money at low interest rates. However, the paradox is now reaching its logical conclusion. The scale of U.S. debt has exploded. Deficits are now a structural feature. It's a slow-burning fuse, one that's been getting shorter with each passing year. These ever-increasing deficits slowly erode the very confidence that makes the dollar valuable in the first place. Foreign nations holding mountains of dollar-denominated assets begin to question whether the United States can truly honor its debts in the long run. This is the core of the problem. The promise that a dollar will always be a reliable store of value begins to fray, especially when the supply seems infinite and untethered to productive capacity. The global system is built not on gold or tangible assets, but on collective belief in the full faith and credit of the United States. When that faith wavers, the system becomes fragile. This crisis of confidence isn't happening in a vacuum. A powerful bloc of nations is actively seeking to build a new system. Brazil, Russia, India, China, South Africa. For years, these nations have been the biggest buyers of United States debt, the very creditors financing America's deficits. But they're now signaling a dramatic shift. They're tired of their economic fortunes being held hostage by U.S. monetary policy. Their rebellion is a direct challenge to the dollar's supremacy. Imagine what happens if the BRICS nations, as a coordinated bloc, decide to stop using the dollar for their vast bilateral trade. Last year, their trade in local currencies was already surging. Now picture them taking the next logical step, collectively divesting from United States Treasury bonds. The demand for these bonds would plummet overnight. To attract new buyers, the United States Treasury would be forced to offer much higher interest rates. This would cause the price of existing bonds to crash, inflicting massive losses on central banks, pension funds, and individual investors around the world. They're creating a shared payment system, a swift alternative, insulating themselves from U.S. sanctions. They are building the institutions to back it. But what truly accelerated this movement away from the dollar? One word: tariffs. When President Trump unleashed a wave of tariffs on imports from China, from Europe, and beyond, the world took note. What Washington called America First was seen by others as economic aggression, a weaponization of the global trading system. News headlines blared about escalating trade wars. Shipping containers stacked at ports' goods left stranded leaders exchanging stern words. For BRICS and many other nations, these tariffs were more than policy. They were a wake-up call. The message was clear. Their economic security could be threatened by the stroke of a pen in Washington. Meetings intensified behind closed doors. BRICS leaders gathered, not just to talk trade, but to discuss how to insulate themselves. Unpredictable United States, a country willing to wield tariff sanctions as tools of pressure. The result? The fire of de-dollarization, once a slow burn, was suddenly fanned into a blaze. Countries began seeking alternatives to the dollar not just out of frustration, but out of necessity. They forged new trade agreements in local currencies, explored digital payment systems, accelerated the push for a new financial order, one where their fortunes weren't tied to the whims of American policy. With every new tariff, another barrier rose, both literal and symbolic, pushing the world closer to a future where the dollar is no longer the only game in town. The true nightmare scenario for Washington, however, does not begin with its rivals. It begins with its friends. For decades, one country has been the most steadfast and loyal buyer of United States debt: Japan. Japan holds over $1 trillion in United States Treasury bonds. Japan is facing its own demographic and fiscal crisis. It has the oldest population in the world, a national debt over 250% of GDP, a staggering figure. For years, the Bank of Japan has managed this by keeping interest rates at or below zero, but inflation is returning. If Japan is forced to raise interest rates significantly to combat domestic problems, it could trigger a sovereign debt crisis. Faced with a fiscal emergency, Tokyo would have to raise cash. And its largest, most liquid foreign asset is U.S. Treasury bonds. A sudden, large-scale sell-off of United States bonds by Japan would be a cataclysmic event. If even Japan is dumping its treasuries, who would be left to buy them? This would trigger a panicked exodus from United States bonds by every other central bank and institutional investor. The bond market would crash, and yields would spike to unimaginable levels. The crisis of confidence would become a self-fulfilling prophecy, a complete collapse of faith in the U.S. dollar. This is the scenario that keeps policymakers at the Treasury and the Federal Reserve awake at night. A move by China or Russia could be dismissed as geopolitical, but a sell-off by Japan would be an indictment of the dollar's fundamental soundness. As America grapples with the vulnerabilities of its financialized economy, the BRICS nations are building an alternative rooted in the real economy of production and trade. This bloc's power is based on command of supply chains, natural resources, and human capital. China is the world's factory, the anchor of global supply chains and a leader in new technologies. India is a rising giant, a hub for technology, services, and a vast consumer market. Russia provides abundant energy to fuel industries. Brazil supplies food, raw materials, and commodities. Together, they form a nearly self-sufficient economic sphere capable of producing, consuming, and financing activity largely outside the dollar system. They have established institutions and are building the infrastructure to back an alternative system. They are creating a shared payment system to process cross-border transactions without touching the dollar. The most ambitious project is a BRICS reserve currency, potentially backed by a basket of commodities: gold, oil, grain. This offers the world something the US dollar no longer can: a currency backed by tangible assets, not just the promise of a debtor nation. This system is designed to be more democratic and less hierarchical. As the BRICS system becomes more robust, the gravitational pull grows stronger, drawing in developing nations seeking alternatives to Washington-based institutions. The allure is powerful: infrastructure, financing, and sovereignty. This project represents the first truly systemic challenge to the dollar's monopoly since World War II. It offers a credible alternative for nations seeking to diversify risks and assert independence. For now, the dollar remains dominant. The scenario of a Japanese bond sell-off has not yet happened. The trust of Japanese investors remains remarkably resilient. They still view U.S. treasuries as the deepest, most liquid, and safest place to park reserves. The global system is so deeply intertwined that the concept of mutually assured financial destruction still holds sway. This inertia, deep-seated faith in the status quo, is the dollar's greatest defense. But we would be wrong to mistake inertia for permanent stability. The ground is shifting beneath our feet. The rise of the BRICS is structural, not fleeting. Their push for a new system is gaining momentum. This new pole of attraction is beginning to pull in even America's traditional allies: Japan, South Korea, who remain security partners yet deepen economic ties with the East. Their economic interests are starting to diverge from geopolitical alignments. They must trade with China, need energy from Russia, access to India and Brazil's markets. They see where the future growth is and cannot afford to be excluded from the new supply chains and consumer markets being forged in the East. This is the ultimate paradox. Allies who upheld the dollar-centric system are now being drawn into the orbit of those challenging it. The choice will no longer be between order and chaos, but between two competing orders, two currencies, and two visions for the future of global finance. The Triffin paradox is finally coming full circle. The system that created American supremacy now contains the seeds of its potential decline. We are not at the end of the dollar's story, but perhaps at the end of the beginning. The decisions made in Washington, Beijing, New Delhi, and Tokyo will determine the shape of the 21st century global economy. A monumental power shift is underway, its outcome far from certain.